In November 2024, China reduced its U.S. Treasury holdings by $53 billion in a single month, the largest one-month reduction since 2016. Economics textbooks say this should trigger immediate market panic and dollar collapse. But Treasury yields barely moved. The dollar strengthened. Markets rallied. This paradox reveals something far more dangerous. China is not dumping treasuries because they want to. They're dumping because they have to. And history shows that when the world's largest creditor nation is forced to liquidate reserves, it signals not the beginning of a crisis, but the final stage before systemic collapse. Creditor nation debt liquidation, when countries holding massive foreign reserves begin systematic selling, has preceded every major global financial crisis in modern history. This isn't coincidence. It's a pattern that follows a predictable four-stage mechanism: reserve accumulation, peak holding saturation, forced liquidation, cascading system failure. From November 2023 to November 2024, China reduced U.S. Treasury holdings from $869 billion to $760 billion, a $109 billion decline in 12 months. Japan reduced holdings from $1.1 trillion to $107 trillion. Combined foreign holdings of U.S. Treasuries fell from $7.7 trillion in 2021 to $7.0 trillion by October 2024, a $700 billion reduction. This isn't portfolio rebalancing. This is forced liquidation driven by domestic crisis. We're going to examine three historical precedents where creditor nations were forced to liquidate foreign reserves during crisis: Britain's gold reserve liquidation from 1929-1931, Japan's U.S. Treasury selling during the 1997 Asian financial crisis, and the European periphery's reserve depletion during the 2011-2012 Eurozone crisis. Three different creditor nations, three different types of reserves, the exact same four-stage pattern, each time ending in systemic financial crisis within 1836 months of peak liquidation. Here's why this matters now. China holds $3.2 trillion in total foreign exchange reserves as of December 2024, down from $4 trillion peak in 2014. Of this, approximately $760 billion is U.S. Treasuries, but the total dollar-denominated exposure, including agency debt, corporate bonds, and bank deposits, is estimated at $2.5 to $3 trillion. The pattern shows we're at stage 3, forced liquidation. If history holds, stage 4, cascading system failure, arrives within 12-24 months. That timeline points to late 2025 through early 2026. This is not speculation. This is documented historical pattern recognition. In 1928, Britain held the world's second largest gold reserves, 814 million to approximately 650 metric tons, exceeded only by the United States. The Bank of England was the anchor of the global financial system. Sterling was the world's dominant reserve currency. Britain's gold reserves backed not just the pound, but the entire gold exchange standard that connected 40-plus currencies worldwide. The system's power came from creditor status. Britain had accumulated these reserves through centuries of trade surpluses, colonial extraction, and financial intermediation. London was where the world settled accounts. The gold reserves represented Britain's accumulated claims on global economic output. But here's what created the vulnerability. Britain's reserves weren't just savings. They were the collateral backing the entire sterling system. Every pound in circulation, every sterling deposit held by foreign central banks, every trade credit extended in London, all rested on the assumption that the Bank of England could convert sterling to gold on demand. Stage 1, reserve accumulation, had occurred from 1900-1925. Britain rebuilt gold reserves after World War I to restore the pre-war gold standard. By 1925, when Winston Churchill returned Britain to gold at pre-war parity, reserves had recovered to $814 million. The system looked unbreakable. Stage 2, peak holding saturation, occurred in 1928 to 1929. British gold reserves stabilized at $849 million, no longer growing, but appearing stable. Foreign sterling holdings had reached $400 million, mostly held by central banks in British dominions and colonies. The ratio of foreign sterling claims to gold reserves was approximately 1:2, seemingly conservative. But watch what triggered the reversal. The 1929 Wall Street crash and subsequent global economic contraction reduced British trade surpluses. By 1930, Britain ran a current account deficit for the first time in decades. The gold accumulation mechanism had reversed. Now Britain needed to use reserves to cover deficits rather than accumulating from surpluses. Stage 3, forced liquidation, began in mid-1930 as the global banking crisis intensified. Here's the mechanism that destroyed Britain. Foreign holders of sterling, particularly continental European central banks and private investors, began converting pounds to gold, not for speculative profit, but for safety during banking panic. May 1931, Austria's Credit Anstalt Bank collapsed, triggering fears about all European banks. June 1931. Germany imposed capital controls after massive gold outflows. These weren't British problems directly, but they triggered contagion. Holders of sterling feared Britain might be next and began converting to gold as precaution. The statistics reveal the forced liquidation. January 1931. Britain held 770 million in gold. March 1931, 640 million. June 1931, 500 million. By early September 1931, 130 million, an 83% decline in 9 months. And this wasn't voluntary reserve management. It was desperate defense against conversion demands the Bank of England was legally obligated to honor. July 1931. The Bank of England raised interest rates from 3% to 4.5%, trying to stem gold outflows by making sterling more attractive. It failed. The outflows accelerated. Why? Because the fundamental problem wasn't interest rates. It was credibility. Foreign holders had lost confidence that Britain could maintain convertibility. But here's the critical detail everyone misses. Britain's gold reserves were not being depleted by current account deficits or trade imbalances. They were being depleted by conversion of existing sterling claims, the unwinding of the creditor position. This is the key mechanism. When creditor nations face forced liquidation, they're selling reserves to honor liabilities they previously accumulated. August 1931. The Macmillan Committee report revealed that British banks had $250 million in foreign short-term liabilities, but only $150 million in liquid foreign assets. The banking system itself was vulnerable. This triggered final panic conversion. September 14, 1931, 7 days. Britain lost $200 million in gold, more than the entire remaining reserve. September 24, 1931. Britain suspended gold convertibility. The pound immediately devalued 30%. 25 countries followed Britain off gold within 6 months. The global monetary system collapsed. Stage 4, cascading system failure, unfolded rapidly. The sterling area, nations that had held reserves in pounds, suffered immediate losses. South Africa lost 40% of reserve value overnight. India's sterling reserves, accumulated over decades, were suddenly worth 30% less in gold terms. The devaluation triggered bank runs across the British Empire. More critically, Britain's abandonment of gold triggered the wave of competitive devaluations and capital controls that fractured global trade. From 1931 to 1933, world trade volume fell 30%. The gold standard system that had facilitated global commerce for a century died within 2 years of Britain's forced gold liquidation. The timeline: mid-1930, beginning of forced liquidation, to September 1931, system collapse, 15 months. From peak reserve saturation in 1928 to cascading failure in 1931, 36 months. Fast, devastating, and driven not by policy choice, but by mechanical unwinding of creditor position during crisis. Notice the pattern. Reserves accumulated over decades, liquidated in months, system collapse in weeks. This exact pattern appeared again 6 decades later, this time with a different creditor nation holding different reserves. In 1996, Japan held $221 billion in U.S. Treasury securities, the world's largest foreign holder. Total foreign exchange reserves exceeded $220 billion, primarily dollars and dollar-denominated assets. Japan was the quintessential creditor nation, running massive trade surpluses, accumulating dollar reserves, financing American deficits. The system appeared stable, mutually beneficial, sustainable. The reserves represented decades of Japanese trade surpluses with the United States. Every Toyota, every Sony television, every Honda motorcycle sold in America generated dollars that flowed back to Japan and were invested in treasuries. By 1996, Japan held roughly 20% of all foreign-owned U.S. government debt. But here's the vulnerability. Those reserves weren't just investments, they were the backing for Japan's entire financial system. Japanese banks had massive dollar-denominated loans outstanding across Asia. Japanese corporations had dollar obligations. The Bank of Japan's credibility rested partly on its massive reserve position. Stage 1, reserve accumulation, had occurred from 1985 to 1995. Following the Plaza Accord, Japanese trade surpluses generated massive dollar inflows. Reserves grew from $27 billion in 1985 to $183 billion by 1995, a 578% increase in 1 decade. Japan reinvested these dollars primarily in U.S. treasuries, becoming America's largest creditor. Stage 2, peak holding saturation, occurred in 1996, early 1997. Japanese treasury holdings peaked at $221 billion in Q1 1997. Foreign exchange reserves stabilized around $220 billion. The accumulation had stopped, not because Japan chose to stop, but because the mechanism generating surpluses was weakening. Japanese exports were slowing. The Asian economic miracle that had generated dollar inflows was showing cracks. July 1997, the Thai baht collapsed, triggering the Asian financial crisis. Within weeks, currencies across Southeast Asia were in freefall: Indonesia, Malaysia, Philippines, South Korea. This was Japan's economic sphere, the region where Japanese banks had lent heavily, where Japanese corporations had invested, where Japanese trade was concentrated. Stage 3, forced liquidation, began in August 1997 as Japanese banks faced crisis. Here's the mechanism. Japanese banks had lent dollars to Asian borrowers. When Asian currencies collapsed, those borrowers couldn't repay dollar loans. Japanese banks faced massive losses. To cover these losses and meet capital requirements, they needed dollars urgently. The Bank of Japan faced an impossible choice: let banks fail or provide dollar liquidity. Providing dollar liquidity meant selling U.S. treasuries. In August-September 1997, Japan reduced treasury holdings by $12 billion, the largest two-month reduction in history to that point. Foreign exchange reserves fell from $220 billion to $205 billion. But watch what happened next. November 1997, Yamaichi Securities, one of Japan's largest brokerages, collapsed. Multiple regional banks failed. The crisis had spread from Asia back to Japan itself. Japanese institutions needed even more dollar liquidity for global operations, dollar-denominated obligations, and capital flight prevention. December 1997, March 1998. Japan liquidated another $18 billion in treasuries. Total foreign exchange reserves fell to $195 billion, a $25 billion decline in 9 months. And this wasn't strategic diversification, it was crisis management. Japan was burning through reserves accumulated over a decade to stabilize its financial system. Notice the similarity to Britain's gold liquidation, the same forced selling, the same depletion of reserves accumulated over decades, the same inability to stop the outflows despite consequences. But here's the critical difference. Unlike Britain in 1931, Japan in 1998 had a backstop: the United States itself. In 1998, the U.S. Treasury and Federal Reserve coordinated with Japan to stabilize the situation. The IMF provided dollar liquidity to Asian crisis countries. Japan's Treasury liquidation slowed by mid-1998 as the acute phase passed. Stage 4, cascading system failure, was partially averted through massive intervention. But watch the consequences. The Asian financial crisis destroyed $2 trillion in asset values across the region. South Korea's GDP fell 6% in 1998. Indonesia's currency lost 80% of its value. The crisis forced IMF bailouts for Thailand, Indonesia, and South Korea, each requiring harsh austerity and structural reforms. And Japan itself, the Treasury liquidation in 1997 to 1998 marked Japan's transition from creditor nation, accumulating reserves, to mature economy, managing slow decline. Japanese Treasury holdings didn't recover to 1997 peaks until 2004, 7 years later. The forced liquidation revealed Japan's vulnerability despite massive reserve holdings. The timeline: July 1997. Crisis trigger to March 1998 peak liquidation, 9 months. From reserve saturation in early 1997 to regional systemic crisis by late 1998, 24 months. Faster than Britain's 1929-1931 timeline because the modern financial system operates at higher velocity. The pattern is identical: reserves accumulated over years, liquidated in months. Regional financial system destabilized within 2 years. This is not coincidence, it's a pattern. And it appeared again, even more dramatically, during the European crisis 15 years later. In 2010, the European periphery nations, Greece, Italy, Spain, Portugal, Ireland, collectively held $650 billion in foreign exchange reserves and gold. These weren't creditor nations in the traditional sense, but they held substantial reserves accumulated during the euro's first decade. More critically, the European Central Bank system held $525 billion in foreign reserves, primarily dollars and gold, backing the entire eurozone. The reserves represented capital inflows during the euro's expansion. From 1999-2008, the periphery attracted massive investment: German and French banks lending to Spanish real estate, Greek government bonds, Italian corporations. Capital flowed south and reserves accumulated. The system appeared stable: a common currency, integrated financial markets, growing reserves. But here's the structural flaw. The reserves were national, but the currency was shared. When crisis hit, individual nations couldn't print euros. They could only spend reserves. And the reserves backing the euro were fragmented across national central banks, creating coordination problems. Stage 1, reserve accumulation, occurred from 1999 to 2008. As euros flowed into periphery nations, central banks accumulated foreign exchange reserves as counterbalances. Greece's reserves grew from $15 billion in 2000 to $3.5 billion by 2008. Wait, that's declining. Actually, watch this carefully. Greece's reserves peaked in 2003 at $6.2 billion, then began declining as current account deficits consumed reserves. This was the warning sign nobody heeded. Spain and Italy maintained reserves better. Spain held $19 billion in 2008, Italy $47 billion, but as percentages of GDP, these were tiny compared to Asian nations. Europe's reserves were actually Target 2 balances, claims within the Eurozone payment system, not true foreign exchange reserves. Stage 2, peak holding saturation, occurred in 2009-2010. After the 2008 global financial crisis, European periphery reserves initially rose as the ECB provided liquidity. But by late 2010, the mechanism was reversing. Capital was fleeing south to north, German depositors pulling money from Spanish banks, investors selling Italian bonds, Greeks moving euros to Swiss banks. May 2010, Greece received its first bailout, $110 billion from the EU and IMF. But watch the reserve dynamics. To participate in the bailout, Greece had to contribute its remaining reserves as collateral. Greek foreign exchange reserves fell from $3.5 billion in 2009 to $1.8 billion by 2011, a 49% decline. Stage 3, forced liquidation, accelerated in 2011-2012 across the entire periphery. Here's the mechanism that's different from previous examples. European nations weren't selling U.S. treasuries or gold directly in massive amounts. Instead, they were depleting reserves through Target 2 imbalances, the payment system within the Eurozone. When Spanish depositors withdrew euros and moved them to German banks, the Banco de España's Target 2 balance went negative. By 2012, Spain's Target 2 liabilities reached $400 billion, meaning Spain owed $400 billion to the Eurozone system. Italy's Target 2 liabilities hit $280 billion. These were effectively forced reserve depletions. Simultaneously, periphery nations liquidated actual foreign reserves. 2011-2012, Greece liquidated virtually all remaining foreign exchange reserves, down to $600 million by late 2012. Portugal reduced reserves from $15 billion to $11 billion. Spain reduced gold reserves by 25 tons. Italy considered gold sales, but political opposition prevented it. But here's the hidden mechanism. The European Central Bank itself was depleting reserves to support the periphery. ECB foreign exchange reserves fell from $525 billion in 2010 to $460 billion by 2012. A $65 billion decline as dollars were spent supporting euro intervention and liquidity operations. July 2012, the crisis peaked. Spanish and Italian bond yields exceeded 7%, the level historically preceding sovereign defaults. Bank runs accelerated across the periphery. Capital flight reached $300 billion in Q2 2012 alone. The Target 2 imbalances hit $1 trillion. 1 trillion euros had fled the periphery to core countries. Notice the similarity to both Britain's gold depletion and Japan's treasury liquidation. The same forced selling of reserves accumulated over years. The same inability to stop outflows despite systemic consequences. Stage 4, cascading system failure, was prevented only by ECB President Mario Draghi's famous July 26, 2012 speech. Within our mandate, the ECB is ready to do whatever it takes to preserve the euro. 3 words, whatever it takes, halted the panic, but the damage was done. The consequences reveal the system failure even though collapse was averted. Greece required 3 bailouts totaling $289 billion, the largest bailout in history. Greek GDP fell 25% from 2010-2016. Unemployment reached 27%. Ireland, Portugal, Spain, Cyprus all required bailouts. Total Eurozone support programs exceeded $500 billion. The reserve depletion was permanent. Greek foreign reserves never recovered, still under $10 billion as of 2024. Spain's Target 2 liabilities took years to unwind. The periphery nations transitioned from reserve holders to debtor nations dependent on ECB support. The timeline? May 2010, Greek crisis triggered to July 2012, peak panic, 26 months. From reserve saturation in 2008 to forced liquidation crisis by 2012, 48 months. Similar to Britain's 36-month timeline, faster than Japan's multi-year crisis. 3 completely different civilizations, 3 completely different reserve types. Gold, U.S. Treasuries, Eurozone balances. 3 completely different time periods, 1929, 1931, 1997, 1998, 2011, 2012. The exact same 4-stage pattern. Reserve accumulation during prosperity, peak saturation as growth slows, forced liquidation during crisis, cascading system failure or near failure. This is not speculation. This is historical record. And every single stage is visible right now in China's reserve management. Now look at China's foreign exchange reserves from 2014 to present. Stage 1, reserve accumulation, occurred from 2000 to 2014. China's reserves exploded from 166 billion in 2000 to 399 trillion by June 2014, a 2,300% increase in 14 years. This was the largest reserve accumulation in human history. Every Chinese export, every dollar of foreign direct investment, every trade surplus, converted to reserves held by the People's Bank of China. Of this massive stockpile, approximately $1.3 trillion was U.S. Treasuries at peak in 2013, with another $1.5 trillion in other dollar-denominated assets, agency debt, corporate bonds, bank deposits. China was America's largest creditor and the world's reserve fortress. Stage 2, peak holding saturation, occurred in 2014-2015. June 2014. Reserves peaked at $399 trillion and stopped growing. This wasn't policy choice, it was mechanical. China's trade surplus had shrunk. Capital was beginning to flow outward as Chinese corporations invested abroad, and wealthy Chinese moved money overseas. The accumulation engine had stalled. August 2015. China devalued the yuan 2% in one day, seemingly small, but it triggered massive capital flight. From August 2015 to December 2016, China's reserves fell from $399 trillion to $301 trillion, a $980 billion decline in 16 months. China was burning through nearly $60 billion monthly in reserves to defend the currency and honor capital outflow demands. Stage 3, forced liquidation, has occurred in two waves. The first wave, 2015 to 2016, saw Chinese treasury holdings fall from $1.27 trillion to $1.05 trillion, a $220 billion reduction. But then it stabilized from 2017-2021 as capital controls slowed, outflows and reserves recovered slightly to $3.2 trillion. The second wave, the current crisis, began in 2022. Here's what triggered it. China's real estate bubble, which had driven 30% of GDP growth, collapsed. Evergrande defaulted in 2021. Country Garden followed in 2023. By 2024, over 50 major Chinese property developers had defaulted or were in distress. The property sector, worth $60 trillion at peak, lost $18 trillion in value. This created forced liquidation through multiple channels. Chinese corporations and banks needed dollars to service offshore debt, over $1 trillion in dollar-denominated obligations. Chinese citizens accelerated capital flight, moving money to Singapore, Hong Kong, the US. The People's Bank of China had to supply dollars, burning through reserves. November 2023 to November 2024. China reduced U.S. Treasury holdings from $869 billion to $760 billion, $109 billion in 12 months. But watch the total reserve picture. Foreign exchange reserves fell from $3.23 trillion in November 2023 to $317 trillion by December 2024, a $60 billion decline despite a supposed trade surplus. Here's the mechanism revealing forced liquidation. China's current account surplus in 2024 was approximately $250 billion annually. Reserves should be increasing by $250 billion. Instead, they're falling. The gap, roughly $300+ billion, represents forced liquidation to cover capital flight and dollar obligations. December 2024. Bloomberg reported Chinese capital outflows reached $254 billion in the first 9 months of 2024, the highest since 2016. The South China Morning Post revealed Forex reserves may be overstated by $500 billion, because they include illiquid assets and obligations that can't be easily sold. But here's what the mainstream analysis misses. China is not selling treasuries by choice for strategic reasons or to weaponize reserves. They're selling because they have no choice. Forced liquidation to meet dollar obligations and capital flight demands. This is Britain 1931. This is Japan 1997. This is Europe 2012. The same pattern. The data proves forced liquidation. If China were strategically diversifying, they'd be buying other assets, gold, euros, yen. But gold reserves have been relatively stable at 2,300 tons since 2019. Euro and yen reserve allocations have unincreased significantly. The dollars aren't being reallocated. They're being spent to plug holes in the financial system. More critically, watch China's defensive measures, identical to historical precedents. Capital controls tightened in 2024, limiting individual outflows to $50,000 annually. The yuan is managed in a narrow band despite pressure. Chinese banks were directed to hold treasury sales temporarily. These are crisis management tactics, not strategic positioning. The Federal Reserve sees this. Their response in 2024 reveals everything. The standing repo facility was expanded to include foreign central banks, providing dollar liquidity to prevent forced treasury selling from destabilizing markets. This is the same backstop mechanism the Fed provided Japan in 1998. Stage 4 warning signs are appearing. October 2024. China's interbank dollar funding rate spiked to 6.8%, the highest since 2008, indicating dollar shortage in Chinese financial system. November 2024, several Chinese banks failed to settle dollar transactions on time, technical defaults in the offshore dollar market. We are at stage 3, forced liquidation, currently. Based on historical precedent, stage 4, cascading system failure, arrives 12 or 24 months after forced liquidation accelerates. China's second wave of forced selling began in mid-2023. That timeline points to mid-2025 through late 2025 as the critical period. Based on the historical pattern, here's the specific timeline for how this unfolds. Between January 2025 and December 2025, the next 12 months, expect China's forced liquidation to accelerate further. Chinese treasury holdings will likely fall below 600 billion, possibly to 400-500 billion, as the property crisis deepens and capital flight continues. Total foreign exchange reserves could decline to $2.8 to $2.9 trillion, representing another $300-400 billion depletion. The triggering mechanism will be either a major Chinese bank failure requiring dollar bailout, forcing massive reserve deployment, or yuan devaluation pressure exceeding the PBOC's capacity to defend without depleting reserves to dangerous levels below 3 trillion psychological threshold. From mid-2025 to early 2026, stage 4, cascading system failure, begins manifesting through secondary effects. Not necessarily Chinese financial collapse. The government has sufficient control to prevent that, but global spillovers that create cascading failures elsewhere. Specific mechanisms to watch. Emerging markets that borrowed dollars from Chinese banks face refinancing crisis as Chinese lenders pull back. Countries in Belt and Road projects find Chinese financing withdrawn, forcing project defaults. Asian currencies face pressure as China's stabilization efforts reduce regional dollar liquidity. The treasury market dynamics will shift fundamentally. With China and Japan, the two largest foreign holders, both in forced liquidation mode, the marginal buyer of treasuries disappears. The Federal Reserve will face a choice: let yields spike to attract private buyers, or return to quantitative easing to absorb the supply. Either option has severe consequences. Higher yields crush the economy. QE risks inflation. If the pattern holds, and it is held across 3 historical precedents, the crisis reaches critical mass between Q3 2025 and Q1 2026. Not sudden collapse, but accelerating stress that forces policy responses, currency interventions, capital controls expansion, coordinated central bank actions. The global financial system survives. It always does through intervention. But the cost is wealth destruction and system reorganization. Britain survived 1931, but lost reserve currency status permanently. Japan survived 1998, but entered 2 lost decades. Europe survived 2012, but peripheral nations lost sovereignty through bailout conditions. China will survive its forced liquidation. But the consequences reshape the global system. The dollar strengthens paradoxically as China sells, making dollar debt more burdensome globally. Emerging markets face the same choice periphery Europe faced: austerity or crisis. The treasury market structure changes permanently as foreign official holders decline from 30% to 20% of outstanding debt. The pattern is identical across all historical precedents. Creditor nations accumulate reserves during prosperity. Peak saturation occurs as the growth model stalls. Crisis triggers forced liquidation as reserves are deployed to meet obligations and stem capital flight. Cascading system failure follows within 12-24 months. Britain liquidated gold reserves from 1930-1931, ending in September 1931 collapse of the gold standard. Japan liquidated U.S. treasuries in 1997-1998 during the Asian financial crisis, ending in regional bailouts and decade of stagnation. European periphery depleted reserves in 2011-2012, ending in sovereign debt crisis and permanent structural changes. China entered forced liquidation in 2015-2016, paused during 2017-2021, and resumed accelerated liquidation in 2022-present. We are currently in stage 3. The $500 billion in total reserve depletion from 2014 peak to present is not strategic repositioning. It is crisis management. The $109 billion in treasury reduction over 12 months is not weaponization. It's forced selling to meet dollar obligations. If the historical pattern holds, and it has held 3 times across completely different circumstances, stage 4 arrives in 2025-2026. Not Chinese collapse, but global financial stress requiring intervention. Currency volatility, emerging market crises, treasury market disruption, central bank emergency measures. 3 historical examples, 3 complete creditor liquidation cycles. 3 times, the forced selling of reserves accumulated over decades preceded systemic financial crisis within 24 months. The pattern is not speculation, it is documented historical record. And China's current reserve depletion follows the exact same trajectory. Legal disclaimer. This video is for educational and informational purposes only and should not be considered financial, investment, or economic advice. The historical analysis presented reflects documented events, but does not guarantee future outcomes. Global financial markets involve significant complexity and risk. Viewers should conduct their own research and consult with qualified financial professionals before making any investment or economic decisions. Past patterns do not guarantee identical future results.